Welcome to our guide on maximizing your 401k match and choosing your very first funds with confidence. First, we will set the core principle. Always capture the full employer match, because that is instant, guaranteed return. Next, we will compare target date funds to low-cost total stock market index funds, and then we will focus on expense ratios so you avoid costly mistakes. Finally, we will wrap up with clear steps, examples, quizzes, and a decisive framework you can use immediately. To guide you smoothly, here's today's agenda. First, we will secure the employer match. Next, we will choose between target date funds and the total market index approach. Then, we will discuss expense ratios and the impact of fees. After that, we will walk through a practical setup inside your 401k. Additionally, we will use diagrams for a decision flow and a TDF glide path. Then, we will reinforce your learning with examples and quick quizzes. Finally, we will end with key rules, a concise summary, and actionable next steps. Before we dive in, a quick but important disclaimer. This content is educational and not financial advice. Your personal situation, risk tolerance, and timeline are unique, so consider consulting a qualified fiduciary financial advisor before making investment decisions. Now, with that in mind, let's move forward and focus on universal principles that are broadly applicable. Now, let's start with the single most important, non-negotiable step. Capture the free money. If your employer matches, for example, 3% of your salary, you should contribute at least that 3% to secure the full match. This match is essentially an instant, guaranteed return on your contribution, which is incredibly rare in investing. Even if you are prioritizing debt repayment, capturing the full match usually comes first because the return is immediate and risk-free. Next, once the match is secured, we will turn to selecting the simplest and most cost-effective funds. Next, let's reinforce why the employer match comes first. When you contribute at least enough to earn the full match, your employer adds money to your account, effectively granting you an immediate return on that matched portion. That is a guaranteed boost that compounds for decades when invested. Furthermore, consistently capturing the match builds strong savings habits and ensures you are not leaving money on the table. With the match secured, we can now talk about which funds to choose so your contributions work as hard as possible. Moving forward, here is a practical setup checklist. First, log into your 401k portal. Then, set your contribution to at least the match threshold. Next, locate the plan's fund list and sort options by expense ratio to identify the lowest cost choices. After that, choose between a target date fund or a total stock market index fund. If you choose a TDF, confirm the expense ratio is at or below roughly 0.5% and preferably lower. If you choose a total market index fund, aim for an ultra-low expense ratio, ideally under 0.1%. Then, allocate 100% to your chosen fund to keep things simple at the start. Additionally, consider enabling an automatic annual increase, for example 1% per year, until you hit your long-term target savings rate. Finally, set a recurring reminder to review your plan annually. Now let's compare target date funds and the total stock market index approach. On the left, target date funds provide a one-fund, hands-off solution that automatically shifts from aggressive to conservative as you approach retirement. This is convenient and reduces decision fatigue, but TDFs can be more conservative for young investors and may come with higher expense ratios than index funds. On the right, a total stock market index fund provides broad exposure to the U.S. stock market at extremely low cost, often the lowest in the plan lineup. This approach is aggressive and historically effective for long-term growth, but it requires you to be comfortable with market volatility and to manage your own risk over time. In summary, TDFs favor convenience and automated risk control, while total market indexing emphasizes cost efficiency and long-term growth potential. Next, let's address expense ratios. The expense ratio is the annual fee that a fund charges to operate, and smaller is almost always better. For index funds, aim for an expense ratio under 0.1%. For target date funds or other active options, be cautious if the fee exceeds about 0.5%. Over time, higher fees significantly erode your returns because the costs compound against you. Therefore, after capturing the employer match, you should prioritize the lowest expense ratio available that still gives you broad market coverage. To make this concrete, Here is a simplified illustration of fee impact on a one-time $10,000 investment over 40 years at a 7% gross annual return. With a 0% expense ratio, $10,000 grows to about $149,745. With a 0.05% expense ratio, the annual cost on $10,000 is about $5, and the modeled ending value is approximately $142,000, a lifetime drag of around $7,700 compared to 0% fees. With a 0.5% expense ratio, the annual cost on $10,000 is about $50, and the ending value drops to roughly $114,800, a drag of around $34,900. With a 1% expense ratio, the annual cost is about $100 per $10,000, and the ending value falls to about $102,900, a drag of nearly $46,800. While these are simplified figures, the key point remains. Small differences in fees create large differences in long-term outcomes. Here we visualize the decision process. First, the flow begins with opening or accessing the 401k. Then it asks whether an employer match is available. If yes, the investor contributes at least enough to get the full match. Next, the flow directs the investor to pick a fund type: a target date fund for simplicity and automatic risk adjustment, or a total stock market index fund for ultra-low cost and broad exposure. After selecting the type, the investor checks the expense ratio. For TDFs, look for at or below roughly 0.5%. For total market index funds, ideally under 0.1%. Then, the investor allocates 100% to the chosen fund for a clean, simple setup. After that, the flow recommends enabling a 1% annual auto increase in contributions to steadily raise the savings rate. Finally, it ends with a reminder to review the plan annually to ensure it still aligns with goals and risk tolerance. Now let's briefly illustrate a target date fund glide path. Early in your career, the fund tends to be heavily weighted towards stocks to capture long-term growth. As the target date approaches, the allocation shifts progressively toward bonds and cash-like assets, reducing volatility as retirement nears. This hands-off, auto-adjusting approach is convenient, but it still pays to check the expense ratio. Lower-cost TDFs can deliver the same automation at a fraction of the price, while higher-cost versions can quietly erode returns. With that context, we can consider the more aggressive alternative for long-term growth. Moving from TDFs to a more aggressive stance, here is the controversial idea. Allocate 100% to a low-cost total stock market index fund. This offers broad U.S. equity diversification with extremely low fees, which maximizes your net returns over decades. However, because it is fully in stocks, you must be prepared for volatility and drawdowns. The key is to keep a long-term perspective and avoid reacting to short-term market swings. Simplicity, cost control, and discipline remain your advantages. Additionally, avoid narrow, niche funds or those with high fees, as they introduce complexity and reduce expected returns without reliably improving outcomes. Quick knowledge check. The question is, what is the very first action you should take in your 401k? The options are: 1. Contribute enough to get the full employer match. 2. Pay off every debt before investing anything. 3. Pick a trendy sector fund to chase returns. Or 4. Split across many funds to feel diversified. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is to contribute enough to get the full employer match. This is a guaranteed return on your contributions and should be prioritized before other allocation decisions. By capturing the match right away, you set a strong foundation that continues compounding for the long term. Here is your second quick quiz. The question is, at what expense ratio should you start to be cautious with a fund? The options are 0.03%, 0.08%, 0.45%, or 0.75%. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct option is 0.75%. As a rule of thumb, you should start to be cautious when a fund's expense ratio is above about 0.5%. Therefore, a fee of 0.75% is meaningfully high and deserves extra scrutiny. To consolidate your learning, here is a concise, markdown-style cheat sheet. First, remember 3 rules. Capture the full employer match, pick the simplest, lowest cost fund, and automate good habits with auto increases and an annual review. Next, when choosing funds, opt for a target date fund for a conservative, hands-off approach, or a total stock market index fund for an aggressive, low-cost strategy. Finally, apply the rule that after capturing the match, you should ruthlessly pursue the lowest expense ratio available. To reinforce your process, here is a one-page decision flow. First, determine whether an employer match exists and contribute enough to secure it. Next, choose your fund type between a target date fund and a total stock market index. Then, verify that the expense ratio meets reasonable thresholds, namely, at or below 0.5% for TDFs, and ideally under 0.1% for index funds. After that, allocate 100% to the chosen fund. Additionally, enable a 1% annual auto increase to steadily improve your savings rate. Finally, review annually to ensure everything remains aligned with your goals. As we consolidate the lesson, keep these key rules in mind. First, always secure the full employer match. Second, favor broad, low-cost funds rather than niche, high-fee options. Third, aim for expense ratios under 0.1% for index funds, and be cautious when fees exceed about 0.5%. Fourth, remember that target date funds are simple and automatic, but can be pricier and more conservative. Fifth, recognize that total market indexing is aggressive, low-cost, and effective for long-term growth. Sixth, automate good behavior with a 1% annual contribution increase and regular reviews. Finally, after the match, relentlessly pursue the lowest expense ratio. To summarize, first, always secure the employer match, because it is free money. Next, choose simple and broad coverage using either a target date fund or a total stock market index fund. Then, focus on ultra-low expense ratios, because costs compound against you over time. Additionally, automate your contributions and schedule annual reviews to keep your plan on track. Finally, maintain a long-term perspective. Time in the market is generally more powerful than attempting to time the market. As we close, thank you for watching. If this video helped, please like it, share it with a friend who is setting up their 401k, and subscribe for more straightforward wealth content. What is your first fund pick, target date fund, or total market index? Share your thoughts and questions in the comments, and we will see you in the next video.